Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Rod Khleif, and I'm thrilled you're here. And we've got a rock star on the show today. His name is John Azar, and I've had his brother Tony on the show as well previously, a long time ago. But John is with MAC. What's the name of your company?
Mac Venture Partners.
Mac Venture Partners. I know that the domain is maccvp.com. John, they own here. When they close on their next group of assets, they'll be close to 6,000 units. How many markets are you in, buddy?
We are primarily in 4 states. That's where we operate in: North Carolina, South Carolina, Georgia, and Tennessee. That's our focus. These are our focus core markets, but we operate technically anywhere from Virginia. We look at deals anywhere from Virginia all the way to Florida and, all the way out to Tennessee and Texas.
Awesome. Well, welcome to the show. I jumped ahead without even welcoming you. Welcome to the show. Can you take a minute? Let's get started before we dig in. Just talk about you. I know you're an immigrant like me, and you were born in Syria. Talk about, how you got here to the States and how you got into real estate. Let's start there if you don't mind.
Sure. Yeah. I got here like a lot of, immigrants get here. My parents decided to leave a country that my father saw no growth opportunities in, which was Syria. And ironically, I don't know if it was good foresight or crystal ball that he had or something. He knew 30 years ago that the country was not headed in the right direction. And obviously he was proven right recently by the war.
Oh, God, yeah, recently for sure. Yeah.
I was 16 years old when my parents immigrated to the States. He sacrificed a lot by moving here. Obviously, my whole family did, but we all sort of pursued our American dream, I guess, if you see it. My brother and my sister and my sisters and I. And
where did you end up?
Part of the family ended up in Boston, and part of the family was in North Carolina. Initially, my brother and my parents were in North Carolina, but then eventually my mother moved to the Boston area, and my brother remained here in North Carolina, and I ended up in the Boston area as well for many years. Yeah.
Love Boston. Yeah, my father lived there for years. We used to go to Faneuil Hall and walk around that area. Love Boston. And so when did you get into real estate? Tell me how that evolved. I mean, did you get right into multifamily? Did you go work for somebody? Did you do single family? Talk about
Sure. That. Yeah, absolutely. My fascination with real estate started out. I started out my career in investments and investment management and equity. I started out on the equity desk with Morgan Stanley, and that kind of metamorphed into more involvement on sort of that side of the business, on the investment side of the business, wealth management side of the business. And when I left Morgan Stanley, and I also worked for Royal Bank of Canada. And when I left with 2 other partners. We started out this structured finance shop that looked at mixed-use development, large-scale mixed-use development financing. Up and down the East Coast, we looked at projects, urban reuse projects, anything from
that's a lot of fun. That stuff's a lot of fun.
Oh, it's a lot of fun. It's a lot of work, and it's definitely a lot to wrap your arms around. A lot of brownfields projects, a lot of Chapter 91 projects, which are like waterfront projects out in the Philadelphia area and the Boston Harbor area, and again, urban core. One of our first project that we brought to fruition was an urban renewal conversion project from a college-owned, condominiums or student housing to convert it to luxury housing on Commonwealth Avenue in Boston. So that was one of our first successful projects that we did as a conversion project. Wow. My fascination with real estate started then, and I knew that when we started in that business, all my partners and I were green. I mean, we didn't know anything.
Really?
We knew finance. We knew numbers. We knew finance, but we had no idea about real estate and how to operate that side.
Wow. Well, you went right into the fire, because I mean, mixed use development. It's guys. Those of you that don't understand, I mean, that's where maybe you've got retail on the ground floor and you've got condos above it, or maybe you've got some office component or something like that. And
right.
The reason it's more complex, well, certainly if you're in urban, you've got all the, it's a lot more red tape in an urban environment. But you also got different tenants you got to be dealing with. You're not only dealing with residential tenants. You've got to find retail tenants, and so it is definitely into the fire. So
right.
Did you actually develop, or did you just finance these projects?
No, yeah, we were strictly finance consultants.
The finance side, okay. Well, that's a great way to get in.
Consultants. What we did was, our role in the deals was essentially to package the deal, put it in a nice bow around it, and kind of send it off and kind of get paid.
So you kind of brokered on behalf of developers to different lending and equity sources and things of that nature?
Yeah, we were what you, I guess essentially what we were as investment bankers for the deals.
Okay. Yeah.
They would bring us in. We would work on the buy side or the sell side. We would sometimes help with identification of the properties themselves. We would identify the equity. We'd line up the debt. Maybe introduce both sides together, and maybe do help with the feasibility study sometimes.
Oh, so you got involved in that as well. Well, that's great. That was great.
Yeah.
Great framework for what you're doing now.
Absolutely.
Doing your market evaluations and sub-market evaluations and demographic, study and all that business.
Yeah.
So when did you get into, actually acquiring for your own account in the multifamily space?
Yeah. So that business lasted until about 2007, 2008. If you remember, something happened back then, I think.
You started right after that? God.
We started before that. We started way before. We started in 2000.
No. I mean multifamily.
Oh, multifamily, we started in 2007. Yes.
Okay.
My brother Tony, again, he was sort of the mastermind in starting the multifamily in 2007. And before that, we were in single family flips. And
oh, you were doing single family flips. Look at that. Look at that. Single family to 6,000 units.
Absolutely.
Wow. Unbelievable.
Yeah.
So Tony started, and where was your first asset? Where'd you buy your first multifamily? And were you with him back then, or did he start and then you joined in?
I was not with him back then. I was involved with the family, but I was not with him actively. It was just starting to build the business, but I was not with him at the time. Mm-hmm. The first asset was in Augusta, Georgia, and actually we still own the asset. My brother still loves that asset. He has almost like a sentimental feel about holding that asset.
Sure.
So we still hold it in it's our oldest asset in our portfolio that we still have it.
When did you join the team?
I joined the team in about 2013, 2014.
Wow. Okay.
And I was in Boston at the time, and then ended up relocating to North Carolina just because I knew we can. Both Tony and I talked, and there's no way I could co-run, the company with him from Boston. Right.
Okay. So when were the bulk of your acquisitions? When did you buy the bulk of your properties?
Well, there was a lot of our companies like us go through certain different inflection points. If you started out in this business, you're gonna change and you're gonna evolve your companies based on these certain inflection points of their business. First inflection point, obviously, is most obvious, is 1,000 units. So when you hit 1,000 units, you start kind of gearing up to look at yourself in a different way. You have to be a little introspective onto what is needed next, because what got you to 1,000 units may not get you to 2,000 units, and what get you 2,000 units is probably not going to be what's going to get you to 4,000 units. So you always have to keep somewhat evolving and changing your strategy and your internal structures to accommodate for that growth. And those next inflection points. I think the first inflection point that was important for us is when we hit about 1,500 units, and that's when we realized that we needed to bring property management in-house.
When was that?
That was probably around 2010, 2011, something like that.
Okay.
2011 timeframe. And so property management got brought in-house around 2011, 2010, and then in continued growth there. And then by 2013, 2014, we were right around probably 3,000 units, 2,500 to 3,000 units.
Wow, you guys have killed it in the last few years then. You've really doubled in size.
And in the middle of that, we were trying to, obviously, you do try to shed some assets. I mean, our average hold time is 3 to 5 years. And, if you're really trying to be an effective manager, not just and a good steward to your investors, you want to try to stick to those timelines, not because just because of timeline, but you want to have market opportunities, and you want to give your investors the best opportunity for market timing as well.
Okay.
So you try to shed some aspects diligently during those hold times. So and then from there we hit the next inflection point, which was around I'd say 3,500 unit, 4,000 units, and then you start looking at yourself in a different way, because then you start to have to gear up from being just a property manager and property owner.
Asset manager.
More of an asset manager and more of an investment manager. So just to some extent, because at that point, your assets and your capital starts to morph into more sophisticated in nature. You have to start looking at capital in a different lens than you did back before you hit 4,000 units. The capital in nature tends to be more maybe private equity or institutional. Or
right. You go to family offices, institutional investors.
Exactly. I mean, traditionally, when we first got started, up until that point, we used a lot of high net worth individuals, accredited investors. I don't want to call them. I'm reticent to call them friends and family, because they're not really friends and family, but they're. In the industry, they're known as friends and family rounds.
Yeah, right. No, got it. Yeah. So let's talk about where we are in the market right now. I'm sure you guys study the market cycle, and you went through 2008. I mean, that was a huge seminar for me, actually. And where do you feel like we are right now?
Well, I think we're in a very interesting place right now. I think we are. It depends where we are. And first of all, we are. I'll preface whatever I say by saying that we are typically, and that's what I advocate for everybody to be deal chasers, not market chasers.
Right.
Because if you end up chasing the deal itself and look at the deal parameter, you will never worry about what the market is doing, because there's always deals that are getting done.
Absolutely.
No matter what the market is doing, whether it's up or down or sideways, if you are looking at the deal and in its intrinsic value and what that deal is doing for you, and
standalone, stress tested, to sustain any downturn. Right.
Look at the numbers. Look at the numbers in a realistic lens, not just in the lens of somebody who's in love with the deal, because once you fall in love with the deal, you lose track of.
That's a mistake. Yeah.
So if you look at the deal in that lens, you'll never have to chase the market, because it doesn't matter at that point what the market is doing. That being said, we are headed into a very interesting market, because we're headed into a market where some of the rates, we're starting to see some realignment in cap rate and interest rates out there, because for a long time, cap rates and interest rates were completely out of whack. And I think they're still somewhat out of whack, but they are starting to somewhat equalize a little bit more, which means expectations from sellers and brokers. And I say brokers because
they influence the sellers, right?
Brokers tend to set the expectations for the seller, unfortunately, whether we like it or not, because that's what we've seen in the past.
They need to get some reality.
Exactly.
Right.
Exactly. 2 years ago or 3 years ago, you'd go to a broker and they bring something to market and they'll say, well, I think this asset is worth this. And, we all look at it as reasonable asset owners. We look at ourselves and say, what in the world is it?
Exactly.
Where did you get those numbers?
Right.
So, now, using even their own parlance, their broker parlance, which is let the market speak.
Right.
The market is speaking a different tune. The market is starting to sing a different tune right now. The market is saying, look, we're not paying 5 cap for 1978 construction that is in a secondary or tertiary area. That's just, let's stop this madness, because that's not happening.
But what's scary is there are people taking those down. And there's going to be a reckoning. They're going to have a reckoning.
Absolutely.
I'm scratching my head when I see what some of these deals are trading at right now.
100%.
It's they either haven't gone through a downturn, or they've got blinders on. And and there's going to be some pain. And so those of you that are listening that are passive investors, be very, very careful who you work with as an operator. And by the way, let me just say something. If you're a passive investor, either sophisticated or accredited, come to my 3-day boot camp, because you need an education. You do not want to make a mistake. And there are mistakes being made right now. And so I've got a 3-day boot camp. Most of you have heard me talk about it. It's in Chicago in August, the 24th, 25th, 26th. Go to multifamilybootcamp.com and come see me there. Even if you're not going to, you're thinking about maybe being active. A lot of people start passively and work their way into active sponsorship. But come see me so you get educated, so you don't make a mistake and you don't align with somebody that's not doing their due diligence and their homework. John, sorry to interrupt, but
No, that's awesome. I want to come to that boot camp.
You're absolutely invited as my guest, my friend. So let's talk about what you're doing to identify deals right now, and maybe talk about how many deals you feel like you're having to look at today to find one.
A lot.
Yeah.
A lot.
Right.
A lot of deals. We look at, the majority of our time right now, and to give you an idea, we look at, my brother and I both look at deals. We have an analyst with us. We have 2 analysts, and we have an acquisition executive that work with us in the marketplace as well. All of us, all four of us look at deals, and we probably look in the excess of, to give you a distillation of what we look at typically on a typical, let's call it typical week, we have about maybe, let's call it 20 deals that come across our box that we are that look interesting to us.
Worth a little deeper dive, right?
Worth a little bit deeper dive. Out of those 20 deals, maybe we look at, we actually make appointments and go see maybe 2 of them, or something like, or 3 of them. And out of those 2 or 3, we hope to maybe make offers on 1, maybe, and it's not even winning that 1 sometimes.
Right.
So
I'm hearing 100 to 1 from some of my other big, partners and players, and
100%.
Yeah.
100%. Yeah, because if you take those numbers and multiply them on a monthly basis, let's call it, there's like told you about 20 deals that we're interested in. That's about 80 to 90 deals a month that we are somewhat previewing to some extent. We are maybe physically looking at about maybe, let's call it 7, 8 deals a month, 6 or 7 deals, 8 deals a month. So it's 80 deals a year. And out of those 80 deals a year, we're ending up buying maybe 3.
Okay. So you're actually looking at closer to 200 or 300 to find one.
That's right.
I've been hearing that, between 100 to 200 to find a deal right now. And that's what you have to do, guys. And those of you that are frustrated that can't find a deal, you just heard what you have to do to find one today. And and it's the overeager people that feel like they must take down that deal because they set their goals on their board and they're going to buy 100 units this year that are going to get their butts kicked when they make mistakes. And there's a lot of mistakes being made right now.
A lot of mistake is being made out there, Rod. It's a lot of what I see sometimes people make a mistake is they line up the debt and they get so excited that they lined up the debt and they go, oh my God, I got to take this deal down because this debt is ready to go. Well, there's just forget about the debt. You can always find debt. There's always people willing to lend you on the right deal. So don't ever feel, sorry or feel, miserable that you've passed on certain debt, because you're going to find that, anyway. And even if you lined up equity and debt, and if you look at the deal, and if the deal numbers are still not making you comfortable somehow or another, the deal numbers are really tight and you're really pushing yourself to make those numbers, don't do it. Don't do it.
Absolutely not. Because listen, what goes up comes down. I mean, ask me how I know. Okay. And I'm just, so let me ask you this, John. Talk about in big, high 50,000 foot view, how you guys stress test a deal. What sorts of things do you do to make sure that you're going to survive any sort of a contraction, like on these 2 assets that you're buying here next month? How did you stress test those?
That's a good question. So we use several parameters. Obviously, we use market comps to look at first and foremost on a macro level market comps. We look at on a macro level and somewhat semi-micro level the area dynamics as well. Not just comps, but the area dynamics, which means what's around. Jobs, economic drivers, school, drivability rating. Where is it near? Where are people coming from? Where, if I was living in that complex, where would I be working? Where would I go? Where would
Where would I enjoy myself? What are my interests? Right.
Yeah. What are my interests? Where is my life? How do I, what's my life look like if I live in that complex?
Right.
So you got to look at all these things in aggregate, and at some point make a decision where, this is still attractive.
Mm-hmm.
And and also you're gonna have to identify through that process. You end up identifying the kind of tenants that you're gonna have in that.
Which is critical. So when you go look at the unit mix, you know whether or not the demographic fits that unit mix, and whether or not it fits the amenity level and all of that. Well,
that's right. And not just the unit demographic today, but the unit demographic tomorrow.
That's right.
Who is moving in that area, not this year, but next year or the year after that. Look at what's developing around it. Maybe it's a C plus asset today or C plus asset area today, but guess what? Maybe in 2 years, they're planning on putting some kind of an entertainment complex and shopping complex that's putting, there's a Whole Foods coming in. You know what?
That's right.
The area is going to go up in the next 2 years. So you got to see what the demographic is coming.
And just let me interject something. And that's why it's so critical to do the homework. You can do it on the phone. You call the economic development office, you call the chamber, you talk to brokers, you talk to property managers, you talk to business owners in that area. Take the time to do it, guys, because you need to know what's expected down the road, positive or negative. Otherwise, you're going to make a mistake. So, okay. So what else?
Yeah, I absolutely 100%. I have those conversations. They might seem like, needless chatter, but they're not needless chatter. I guarantee you they will give you more insights. Walk into a restaurant, owner and say, hey man, how's the area? What's going on here? How long you've been open in this area? You'd be amazed what kind of market intel you would get.
That's right.
Out of a local restaurant and what they can tell you about the area.
Yep.
You'd be amazed at what you could tell from a shop, like a boutique. Walk into a boutique and say, hey, how's the area? How's business going? You might hear something you don't like.
It's very possible. And you're going to get the real insight that you won't get from somebody that's got secondary gain, like a broker or a property manager as well. Exactly. No offense to brokers or property managers, but we're all in sales. And so, somebody that's got nothing to gain from their conversation with you will give it to you real. And those conversations you have to have. All 100%. Right. So that's the area.
So that's the macro. Yeah, that's the macro level. So then you dive into the micro level, which is the property itself.
Mm-hmm. Let me add one thing on the macro level that I just want to add my listeners. It's critical that you look at the employment base. You look at the types of employers that are there, that there's diversity, number one. We just did a deal in Beaver Creek, Ohio, and 17 different employment types, but also look at the types of employment and think about how they would react or survive in a contraction. Are they contraction resistant? Like in this particular Dayton, Ohio deal, we've got higher education, we've got healthcare right there next to this property, we've got a military base that will survive anything because it's a tech research facility. So a lot of diversity, a lot of recession resistant industries. So make sure you look at that kind of stuff, be thinking about those things. Anyway, please continue. So micro.
No, absolutely. You're right. And it's a lot of times just to stay on that macro level, a lot of all employers are not equal. So if you look at something in there, there's like a manufacturing base near your apartment complex, don't automatically assume that it's low level paying or low level blue collar jobs, because a lot of it is not. It depends on the manufacturing. Mm-hmm. If it's high level manufacturing, some of those jobs are in the six figures. It just depends.
Right. Big money. And so then you've got to look at your property, your asset. Is it in an AB asset that'll appeal to that demographic, or is it a C asset that really doesn't even apply? You've got to look at, and jobs drive everything in this business, guys. So just let me hammer that home. All
Absolutely.
Right. Please
100%.
Continue.
So then you look at the micro, which is you come down to the numbers. I mean, you start looking at the numbers. You start looking at you dive into the rent rolls. You have to really understand, where are the current rents coming from? What's going on with the current rents? What are they charging? What kind of different unit mixes they have in that apartment complex? Did they do any upgrades? What kind of upgrades did they do? What did those upgrades cost them? Why did it cost them that much? You look at some upgrades and they tell you, "Whoa, it costed us $10,000." And you look at the upgrade and you're like, "I can get that done for $2,000. Why did it cost them $10,000 to do that upgrade?"
So trust but verify. because you're going to get a lot of BS, and it's important that you weed through it.
Well, a lot of times it's not even BS. Sometimes it's just mismanagement. Like,
Very good
a lot
point.
of times it's like, well, yeah, we spent $10,000 on that unit to upgrade it, and you look at the unit and you're like, I only see $2,000 worth of upgrades here.
Yeah, very good point. Yeah,
you either overpaid for your upgrades or you just did a crappy job in sourcing your labor. Something didn't add up. That
right.
You spent $10,000 on this unit. So, which is good for you because that means you can do it for a lot cheaper and upgrade it a lot cheaper. So look at those numbers first. And again, you have to understand where rents are today, what you can push them up to, what the market is around them can be pushed up to. And that is done also by talking to property managers.
And driving around. You've got to go visit those competing properties and make sure
absolutely.
You're talking about apples to apples, and, see what your competition is, and, make sure that whatever class aligns with what the asset you're looking at. Ideally you want to beat them out on amenities if you can, or bring, then you're going to know what level you have to bring your units to actually compete or to ideally beat your competition, right?
100%. And a lot of times, believe it or not, that's something that's sometimes overlooked is the property management itself. Property managers.
Sure.
A lot of times property managers make or break it,
Oh, sure.
I mean, they are your frontline salespeople. That's who sells your property. That's
right.
When somebody walks in, a potential renter into a property, the first line of defense is your property management team. That's, the PM is essential. So when you go, and you'll find that out when you go to visit different properties, you go into a certain property and they may have the same amenities you do, but their occupancy is like 5% higher than yours. And you're like, I don't understand. Why is it 5% higher than us? Is it because it's much better? And you go and visit a lot. It happened to us. It happened to us recently, actually.
No kidding.
You go and visit different property and you're like, wow, the property management is stellar. They are amazing. They are on point. They ask the right questions. They follow up. They
build rapport, build relationships, and then people feel bad if they don't rent from them.
Absolutely. And they get up from their seat, they greet you right. It's I know it's little semantics, but it makes a difference, guys. It really makes a difference. If your property management, you walk into the property and the property manager barely gets up out of their seat, barely talks to you, acts like they're doing you a favor by giving you rental information. If you decide to move forward and buy that property, the first thing you need to do is fire that property manager.
No question. And that ties into something else. You've got to stay on top of managing your management and ideally mystery shopping them. And again, trust but verify. Have friends or family pretend they're interested in a unit and see how they react. And obviously you start with training. You've got to train them properly. But and a lot of the big players like you guys that I interview have brought their management in-house. I'm a big proponent for self-management. You waited till you were at 1,500 units. Great. You've got an infrastructure. It makes sense. And nobody can do it better than you can. I mean, I had Albert Barras on the show. Great guy. He's in my mastermind, and he's got 17,000 units and self-management. That's when you can really put some controls in place and really keep an eye on things.
Absolutely. And it helps you. I mean, it helps you with cost control. It helps you with, people control. It helps you with knowing what your market is going to be. And market intel alone is worth the while.
Sure.
It may not end up being a huge profit center for you. It's not necessarily a huge profit center for us, if I'm being honest, but it's an indispensable part of our company. We cannot do it.
Got it. Again, you're either going to pay a third party and manage them, or you can manage your own staff. And me, I'm a big proponent for self-management when it makes sense. Not when for those of you that are getting started that heard me say that, if you shouldn't be dealing with toilets when you're in acquisition mode, if it's just a team of one. Okay. So don't do that. But once you have enough of an infrastructure, these guys were at 1,500 units. It's a no brainer.
Absolutely.
So let's shift gears for a minute. Well, we didn't finish the stress test question on a financial basis.
The rest of it, as I was going to say, is really, it comes down to numbers and finance. You got to make sure you're doing the right pro forma. You got to look at the numbers. You got to get yourself a good pro forma. Meaning a good underwriting. I don't know if we do 15% vacancy.
we'll do like a 15% vacancy. We'll drop the rents down, and we'll look at what our actual break even is. What's the worst case break even and still cover the debt and returns, things like that. Is that the sort of stuff you do as well?
That's correct. That's correct. Yeah, absolutely. Okay. You look at vacancy, you look at expected vacancy, what your shrinkage amount is going to be. If you take if a contraction happened in the market, what is that going to cost you? Is it going to cost you 2%, 1%, 4%, 5%? What is that minimum point where you should still meet your obligation? You can still be profitable. You can still do your distribution or meet your pref rate, but not be in trouble. And if you are in trouble, even go beyond that. And if you are in trouble, how long can you sustain that trouble? Can you be in trouble for 1 month, 3 months, 6 months?
Right. Are you guys raising operating capital as well? A lot of the big players.
So the way that we raise capital when we syndicate a deal is we put everything up front. So our CAPX is in upfront in the deal.
And operating money.
And operating. Well, operating capital is obviously coming, but yes.
Same here. You raise it up front. It's there. It's a rainy day fund. If there's an issue, you've got it. You've got your CAPX. It's not, any guys don't ever try to do your CAPX from operating funds.
God no. Oh my God. Yeah. All that is the worst thing that anybody can do.
Right. And that, one of my questions I frequently ask is, how do people fail in this business? That's one way. If you want to get right to it, that's one. In fact, let me ask you this. Do you have a favorite failure in your life that set you up for future success? Let's talk about when you got your nose bloody. Talk about if you've got an example.
I mean, the earliest failures, but way before I was in the multifamily industry, back when I had that structured finance company.
Okay.
Is the biggest failure. And it was actually in Boston, and we had 3 projects going on in the Boston waterfront. And we thought that they were tied down. I mean, we thought that the projects were a done deal. We had already found the developer. We had found we'd find the financing. It was something that we were buying, for a very sweet deal at the time. We thought was a sweet deal at the time. And man, my partners and I were, we were.
Champagne corks were being popped. You guys were celebrating.
My partner went out and bought a BMW because he thought he's like, it's an early celebration of this deal. And, next thing you knew, literally overnight, in 2007, I remember it clearly day, everything went just black. It just went black. Wow. As if somebody just pulled the plug.
Please. Let's change the subject, because I'm gonna start crying. Same here. Okay. All right.
Yeah.
But let me ask you this. What was the lesson in it?
The lesson in it is don't be overconfident on your deal. Be realistic. Look at worst case scenario. Hold back until you know that you have a signed deal. Hold back until you know that everything is in place. And not only that, but keep at it even after the deal is signed, because the deal is a live animal. It doesn't die after you sign it. The deal doesn't stop working for you after you sign a deal and it becomes yours. In fact, if anything,
that's when the work starts.
That's when the work starts. That's when the rubber hits the road. And that's when you start, have to be, if you don't want to get those angry calls from your investors, if you don't want to have to make calls to your investors and say, I need a capital call, which you never, ever want to make.
That's the worst. That's the
worst call you could possibly make to your investors. You got to stay on top of your deal. You got to stay on top of your deal and always be humble. Always be humble.
Yeah. No, that's sound advice. Now, let me ask you this. What advice would you give an aspiring multifamily investor? I've got a lot of listeners that have single family homes like you started out with. Maybe you've got a duplex or 2. They know they want to do larger deals. They're all excited listening to you talk about having 6,000 units here in short order. What advice would you give that person?
Well, start what you can bite. I mean, you can eat the whale one bite at a time. I mean, so you can't don't look at it all in. It's overwhelming. If you look at it, it's good to think big. Think big. Right. Don't think small. But execute on the small baby steps. To get there. Think big, but act as in
love
diligent.
It. No, I love it. Steps. Love it.
Go ahead.
No. I'm sorry. If you had another thing to add, please do. I'm bad about interrupting. Please.
No, all I'm saying is start what you can chew on. So
yeah, everybody has a courage muscle, and it really is a muscle, and it grows through. I think the hardest deal is the first deal. There's like the law of the first deal. Once you get that first deal, they pretty much fall like dominoes because you push through the fear. But let me ask you this question: if you could go back in time, knowing what you know now with your incredible success, what would you tell your younger self about this business? Is there anything you might do differently?
I would have started much earlier.
Yeah. Every single time I ask that question. Guys, I hope you're hearing that, okay? Every single time. So push through the fear. Take massive action. Go make it happen.
100%.
Okay.
100%.
All right. Is there Is there any defining moment, any aha moment in your career that was like a pivot point for you in this business? Anything that comes to mind? It's okay if not, but
look, I think I'm a big, proponent of learning. I learn all the time. In fact, that's why I'm in this business. That's why I love it, because I feel like I learn something new all the time, and that's what gets me up in the morning. That's what gets me excited. That's why we go on property inspections ourselves, and we walk in and, we have the crappy days and the bad days, and we learn something from both those things. Sure. Do I have one aha moment? Maybe not one. I mean, I might have, maybe I have one back, I had one back in maybe 2015, 2016, when I realized that, man, this is a great business. This is, we are in a business.
No, that's what I'm talking about. Yeah.
So, in a business where what other business can you get up, execute your things, make people happy, make people money, but at the same time, make yourself money, right, and grow a legacy to hopefully your family and
children, grandchildren, their children. I no question.
You got it. And if you're not excited, don't be in this business. Go find something else. Go be a banker.
That's right. Do what you love. I'll tell you, I tell my kids that, and, I never thought I'd be doing this education platform that I'm doing now. In fact, my team still thinks I'm nuts, but I freaking love it. I love the podcast. I love coaching and all that stuff. I just love it. Do what you love, and work is play.
Absolutely.
Well, listen, you've added tremendous value, buddy. I really appreciate you being on the show. It was absolutely my pleasure, and I'm honored that you took the time out of your day to please say hello to your brother for me.
Absolutely. It's my pleasure. Thank you so much for having me. That was awesome. Thank you so much. Good luck, guys. Okay.
Thank you.
Thank you for listening to the Lifetime Cash Flow Through Real Estate Investing podcast. If you've enjoyed the show, please take a minute to visit iTunes and leave your comments. For more resources or to connect with us further, please visit our website at rodkhleif.com. Tune in next week for our next show.
Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws.